The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everybody. This is Dan with Nadex. Welcome back. For those of you joining us again, I see a lot of familiar names from the last couple of days. We've had great groups. And if this is your first one of the week, welcome. Today we're going to be covering Nadex knockout contracts. So yesterday we covered binary options. That video should be ready later this afternoon. I'll show you as we get towards the end where you can find, where you'll be able to find that, as well as the Tuesday webinar that we did on the platform overview. So with that, what we're going to be covering today, we're going to be talking about the basic elements of knockouts. This will be a pretty high level overview, but should give you all the information you need to get started, particularly trying them out in your demo account, giving you some good footing to get started on. That's the goal today. We're going to look at finding the contracts, talking about contract value, how to execute trades, and what risk profiles look like on these trades. How you manage those positions in closing out, and what the capital requirements, which, if you've been with us the last couple of days, you understand every contract at Nadex, the capital requirement is always in direct correlation to the risk on the trade, the same value. And we'll have lots of time for questions. So before we begin, and you've heard me go through this probably the last couple of days as well, but it is very important to understand. When you see these, I don't care if it's my presentation or anybody else's, the most important thing, I don't care what your strategy is, I don't care what your methodology is, I don't care what your plan is, the most important thing is understanding the risk on every trade, because trading does involve risk. It's not appropriate for all people at all times. If it's a matter of having the funding to trade, it has to be risk capital. It can't be earmarked for anything else that you need to support your day-to-day life. Psychology of trading is hard enough when it is risk capital. If it's something that's like a car payment or a grocery that it's earmarked for, you can't be successful that way. So we want to understand that. Nadex is also all about giving the individual trader an opportunity to express their own opinion, to make their own decisions, to take control. With control, we have to take accountability. So your decisions are your responsibility. I am going to be in the platform for most of this presentation today. Going to be executing trades in the demo environment. And so if you do have a live account, please don't follow along thinking that this is any recommendation or that I'm saying, hey, buy or sell this. We might do a little bit of analysis to show the platform, but for the most part, these trades are just going to be showing the execution, how you determine risk on a trade, things like that, right? And Nadex is subject to regulatory oversight by the Commodity Futures Trading Commission, the CFTC. All right, so today we're just going to cover really the basics of the knockouts. Knockouts are really unique in that they really replicate the movement of the markets you're familiar with. So if you're coming from the futures side or Forex side, or you've wanted to trade commodities, even from the stock side, right? We understand what markets look like when they go up. We understand what they look like when they go down. That's how these contracts work, and I'll talk a little bit about the history of them as we go along as well. Basically, a knockout is a range trade. It's defined in a range of a floor and ceiling. The floor and ceiling define the maximum risk and potential reward on every trade. They're called knockouts because if a floor or ceiling get touched, or in the case of a really fast market, they can get gapped, but there's no slippage on these. So even if they get gapped, they're going to be what's called knocked out, and they're going to get expired and settled at that exact level. We'll walk through this on the charts. The capital required to place these trades, and what's so unique about these is, if you went and tried to trade oil, say the CL contract on the CME, the margin requirements would be extensive, particularly now. Most margin requirements were raised in the last few weeks ahead of the US presidential election for a good reason, right? Nobody knew what the volatility was going to be. A lot of contracts, actually oil, if you remember last April when it went below zero, nobody thought that could happen. Commodity futures can go below zero, just to let you know. Very rare occurrence. I think that was the first time in history it's actually happened. It took a lot of people by surprise, but they involve a lot of risk. When you're looking at a contract like CL that moves $1,000 a point, there's a lot of risk involved. What these knockouts will do, if you're interested in trading something like gold or oil, they give you an opportunity at a relatively low capital requirement. And so you don't have to put out a ton of money. And we'll walk through all that as we get into the charts. Another thing I'm going to stress is while all Nadex contracts are bound, right? We talked about binary options yesterday. They trade between 0 and 100. We'll look at the knockouts, how they trade within a range. Tomorrow, we'll be looking at call spreads. You can always close out a trade early to lock in profits. You don't have to sit there to wait for it to be knocked out, right? If the market starts going against you, you can close out the trade for a smaller loss. While there are maximum values on both sides to every contract, which is great, right? Because if something happens, I mean, I go back 2007 when the carry trade unwound, which was a big trade that was popular, an interest rate differential in 2005, 2006, it really picked up steam. A lot of people got crushed in 2007, which was the first time there was 4 central banks that all basically had an impact on the currency markets. There are things like Swiss National Bank intervention. Who knows, World War III. It doesn't matter what happens in the outside world as far as your trade is concerned. Obviously, if it's World War III, it's probably a big concern for all of us. But as far as your trade is concerned, once you get locked into a trade, you can never lose more than the capital you put up for that trade. That said, again, you don't have to lose all that capital. If you can get out early at a smaller loss, or maybe you look at the market and you're well into profitability and you say, you know what, I think it's run out of steam here. I think it's time for me to close out. You can do that. So they offer the flexibility. Oh, and Carmen, yeah, I'm going to show you where you can get the recordings. So the one from yesterday should be posted a little bit later today. The one from today, because it takes some time to render it, get it posted, a lot of data gets passed. They typically get put up the next day. So I'll show you that at the end. By the way, and these are being recorded, if that wasn't apparent from this comment. These are being recorded. I definitely encourage questions and interaction. We've had great groups the last couple of days. One of the reasons why I think it's so important, and never be shy to ask a question. I've spent a lot of years in this industry. I've learned actually as much from questions from people that are brand new to the market because fresh eyes provide fresh insight a lot of times. So there are no stupid questions. I encourage you to get involved. And when you ask a question, that's the importance of these group settings. One-on-one is fine, but I don't think it's nearly as valuable as this. And the reason I encourage questions is because you'll ask a question that somebody who's newer or maybe doesn't have the trading experience won't think to ask. And so by them asking it, right, we don't know what we don't know. By them asking it, I can answer it. Or if I don't know, I'm just going to tell you all, hey, I don't know. Maybe we'll discover it together. But it helps everyone. So ask those questions. I just got a great comment. Somebody who's new to knockouts, followed them the first time and enjoyed the process. I'm very happy to hear that. I'll mention why I'm a bit biased to this contract as well as call spreads. I'll go into a bit more tomorrow. But with that, let's just hop into the platform and get right to it. And give me 1 second. In a second, you should see my platform. Everybody good on the platform? All right. So in the upper finder here, you'll see knockouts. Simply click on knockouts. We have knockouts on 3 asset classes: indices. So we have all the major US indices. If you're new to Nadex, maybe you've traded futures before, right? If you look at a name like the S&P or the E-mini S&P 500, those are trademarks. So Nadex is not allowed to use those. However, I think we can mostly figure out US 500. That's based on the CME E-mini S&P, US Small Cap 2000, the mini Russell, US Tech 100, the mini NASDAQ, so the tech sector. And then the Wall Street 30 is based on the Dow mini contract. Right? So very familiar contracts, very, very liquid underlying markets. We also have Forex pairs. So we've recently added a few more Forex pairs. There's 10 Forex pairs, the most popular Forex pairs. And then, as I mentioned earlier already, commodities, got crude, gold, natural gas, and silver. Now, one thing you'll see is we talked about the different periodicities yesterday on binary option contracts. Now, knockout contracts are a weekly contract, meaning they start on, they'll start at the beginning of the week and then they close it Friday. But throughout the week, and we'll walk through this process, they get knocked out and new ones replace them. Additionally, if you're a very short-term trader, you can trade these intraday just as easily as you can trade the underlying markets on an intraday basis. So if you're very short term, these are basically a replicant of the futures contract. They allow you to get in and maybe a smaller size for that, which if you're used to trading, say something like the E-mini S&P, well, that's easy. Then you just put 5 of these on and you've got pretty much the same equation, only you get the flexibility of being able to scale in, scale out using multiple contracts. So let's walk through just a couple of trades here, and we'll walk through the whole process. Right? I'm not going to do a lot of analysis here. We're going to walk through. I'm going to just pick up the US 500 CME E-mini. You know what? Let me clear up my chart because I had a bunch of stuff on there from yesterday. We're just going to clean this up a little bit. All right. So when you go to a knockout chart, do you remember how we had the binary? Yeah, these are actually very similar to the micros as far as the futures. Now, I haven't seen a micro oil yet, so that's different. Where these are a bit different, and we're going to walk through this. I actually call these contracts discipline for when you don't have it. I've mentioned in the last couple of presentations, I've been around a while. I was a trading coach for quite a few years. And I saw a lot of the same things, particularly as it pertains to both the risk side and then the profit side, where discipline really comes into play and where most people struggle. They end up taking larger losses, right? Because they want to be right. And you wouldn't believe the number of conversations I've had where people are just bleeding cash. They're trading Forex or futures and they're just bleeding cash because they keep moving their stop farther away. And then they just pull it or they have a mental stop. And it becomes almost a thing, and I've just seen it happen so many times, but it's kind of funny. You can call somebody that's bleeding cash and you're like, well, how are you doing? And they're like, oh, I'm doing great. And you'll look at their account and had $5,000 and now they're down to $3,000 in a couple of weeks. And you can't believe they're happy, but they come back with this comment that, I'm right 72% of the time. Being right does not matter. Some of the best traders I've known in history were maybe right 20% of the time. They were just really good at understanding when the market was when what they thought was going to happen didn't happen. They just got out of their trade. They waited for the next one. They showed discipline and patience. But when the market went in their favor, they were very good at managing it. And so that's a big one. It is funny. And all of us can struggle a bit with discipline at times. It is easy to say and to speak about, much harder to implement. All right, so we've got our chart here, and I'm going to close my position windows for a second just to give us a little bit more room here. So where we had the binary strikes yesterday, and I'll just slide this chart a little bit. With the knockouts, you're going to have 4 unique ranges. So I'm just going to pop through these. The reason for this, we wanted it to be as easy to buy if you think the market's going up as to sell if you think the market's going down, right? We wanted to be able to, the whole purpose of these is to be able to limit your risk, which limits your capital requirements to place the trade, but also gives ample upside opportunity. And so over here, and it might be a little difficult when you're on your platform at home, you should be able to see this, but I'm going to highlight. So this contract right here is a range. So do you see the upper and the lower blue lines? So typically, I'm going to say typically, because like everything, there's always some flexibility. The far left range, if you're looking to buy, is going to give you the most attractive risk to reward profile. Whereas the bracket to the right, the knockout to the right, is going to give you your most attractive risk to reward profile if you think the market's going down, meaning if you want to be a seller. Now, in certain instances, right, there's an old saying, don't smother the market. If you're looking at a knockout that is a couple of ticks, let's say the market was right up near this top blue line on the screen, that might be too close for comfort. That might not give you enough room to breathe. Yeah, it's a really cheap trade and you can take it, but you may get knocked out pretty quick. right? So sometimes there's a balance. Sometimes you may want to say, I'm going to take on a bit more risk and choose what I'll call bracket number 3. So let's go in and place brackets. But typically, rule of thumb, the far left bracket. So let's do an example of going along the market. So if we're going to buy this contract, this floor here, the bottom blue line, if you see where those two candles kind of went almost to it, if they would have touched it, this contract would have knocked out. So I'm just going to go and say, I'm going to buy this contract. So if I buy one contract, this contract is a total of $500. Really easy to tell that. So if we go over to our order ticket here, we look at this. So if we buy here, if this floor gets touched, this floor as a buyer, the floor always represents our maximum loss. So in this case, our maximum loss if this is touched is $64. Our maximum potential profit is $436. So we've got a pretty strong risk reward ratio, right? And pretty low cost of entry. So $64 plus a $1 exchange fee to execute one contract. I'm going to go ahead and execute this trade, and I'm going to actually trade 5 contracts here because I just want to walk through some examples. So I'm going to go ahead and place this order. Now, yesterday in binaries, we talked about different things that impact the price, right? Volatility, how they move, sometimes when it's a slow market. If you've traded Forex, if you've traded futures, even if you're newer to those markets, and let me bring up my positions window here so we can keep track of this, right? So if, and in a way, I kind of hope like this goes down and we get to see a knockout in action, right? I wouldn't hope that or wish that if this was a live account, right? Because then it's real money on the line. But as an example sake, I think would be really useful, and we'll show how these list. Because if this gets knocked out, we're basically going to replace it with another contract at a lower level so you can continue to find opportunity. And so we're a little bit slower. I'm doing these in the afternoon, so the market might not be moving. But here's the great thing about the discipline. I'm in this trade. One, from a psychological perspective, I don't have any stress. I knew that trading 5 contracts, I have a max loss. In this case, it was about $285. By the way, we've got a couple ticks up. So right now we're in profit of $25. But if it goes down here, right? And so think about this if you're looking at support and resistance levels, right? If you're seeing support maybe a bit higher, this would be pretty close for comfort actually right here if we're looking at this as a floor. But if we see support, then we might want to choose a floor if we're a buyer that's below that support level. Now that I have a position on, right, I have a pretty good risk reward ratio, right? We just talked about it. It was something like $68 per contract to like 434 something or 432, something like that. I don't have to wait. This ceiling is my maximum potential profit, right? I probably don't want to wait for that though. I traded 5 contracts, right? What's the old market saying? Bulls make money, bears make money, pigs get slaughtered. I'm sure everybody's heard that a million times, so you're probably like, oh, Dan, stop with the old analogies on markets, but it's so true. And the thing is, like what we don't want to do is we don't want to see the market run up like this, and we're like, oh, we're greedy. The nice thing is if the market does make a big run up, our greed can only go so far. One of the things I've seen, in addition to people just like pulling stops and not managing risk, and I remember this on this one call, I used to do a Sunday night. And actually, I used to do a daily evening webinar back in the trading days, and this was when I was licensed and I could give basically recommendations. And I would walk through analysis and we'd place trades. And we placed this trade, and it was on the pound yen pair. The market came down, we got filled, we had a plan. Or you always have to have a plan, right? You have to know if you're going to get into a trade, you have to know how you're going to get out. And that's one of the reasons why I really like these contracts. It's because it gives you a built-in plan, right? But you still, as a trader, need to execute another plan. So back to the story. So it's the next morning. I'm in the office. It's about 7 a.m. I get a call from one of the coaching students, and it turned out to be a really great trade. The market ran up. It hit our first profit target, our second profit target. and then it turned and whipped down. But we should have all been out of the trade. So he calls me up and he says, Dan, he's like, hey, I took that trade last night. And I was like, oh, hey, great. Yeah. And he's like, well, no, he's like, when should I get out? And I'm looking at it and I'm like, it's already below our entry. Now he's losing money. And I was like, well, I can't tell you that. You should have got out. And this conversation I've had hundreds of times, right? We need to have a target. Like for instance, maybe we think, and then there's all different ways to hit targets. People use different things, levels of support and resistance. Maybe we think our first profit target, right, is right here where we saw like right where support, previous support, and this is very short term basic analysis, becomes resistance. So maybe we think it's going to shoot up here. Let's just mark a level, 35.44. I'm going to place a couple of limit orders now. 35.20, right? Again, when you want to place a limit order, click on it from your positions window. When you do that, it's going to open a ticket in the opposite direction. So what do we say, 35.44? I'm just going to type in 35.44, and I'm going to take 2 contracts off at that, right? If I can get to profitability, if I can lock in, I've now basically managed my risk to a certain extent on this trade if I get filled on those, because then I'm down to 3 contracts. Maybe I say, okay, if the market really does catch that, maybe we go up to 35.60. Again, I click on the open position window. I'm going to put in 35.60. And I'm going to take another 2 contracts off. And so let me draw a couple lines on the chart here. I'm going to do a horizontal line. So we took one was right about here at 35.44. We have a limit order for 2. Just going to click on this line. By the way, if you double click on it, that's how you do your settings. So if you don't like the color red, you can change it to blue. You can change the width. You can do whatever you like. I'm actually going to leave it at red because on our brackets, they're already blue. So apply. That's our first level, right? I right click. I duplicate this line. I'm just going to take this line up to, we said, right around 35.60. Right? So now we've got these limit orders. So if the market comes up like this, we get filled, we lock in profit. Now we still want to manage our trade because if it comes up here and it starts, tapering, we may say, oh, the market's going to turn. Maybe we want to just close out the trade. And I'll show you how to do that in a second. But if the market keeps running up, okay, now we've locked in profit again. If the market keeps running up, this is automatically going to take us out. The top level, that'll take us out at maximum profit. So maybe we look at this though, and we're just going to say, okay, we're up on this particular trade. We're currently up. If you always want to know where you stand, right over here, we're up $190, $200 now on our 5 contracts, right? So we'll maybe just let this one play out and see what happens. If it's like a lot of trading, it goes up a little bit, we get some profit. We don't take it, it'll go down and it'll give us a loss. So trading decisions still have to be made, even though this has discipline for when you don't. So let's take a look at a short contract. And I'll actually talk about a trade that was a pretty big volatility trade back in March. There are some, there's currently no OC orders, Adam, for any of the contracts. That's actually something I literally had a meeting about yesterday where some different order types. Right now on the knockouts, you're always going to use the floor as your maximum, as your knockout range if you're long, and the ceiling, as we'll discuss in a second, if you're short. You can put those limit orders out there though. And the thing is, so if you hit, so let's go back, I'll go back to this previous range. So if I go up here and I hit, similar to an OCO order, which I think is your question, if I go up here to this first red line and it takes 2 contracts off, and then it just drops down and stops and basically hits that knockout, it's only going to knock out for the number of contracts I have left. So it's very similar to one cancels other, because this is only going to knock out the number of contracts I have. If the market runs up here, we get filled on 4 contracts. I've only got 1 remaining. If it drops down and knocks out, I'm only going to get knocked out at 1 contract. So unlike if you had, let's say, a stop order for 5 and put a limit order for 2, right? A stop order is an actual order. The bracket ranges, the floor and ceiling, simply kill the trade with whatever's remaining. So they do act a lot like an OCO order where one cancels other. Yes, great question. Yeah, in order to do a limit order, you're just doing a good till canceled. And I'll walk through that on the next one as well on making sure you set those. You don't want to do a market order in that, right? Because you basically want an order that's going to fill at that price or better. You don't want an immediate fill. So let's go look at a short or a sell position here. So in this case on the sell, I'm going to move my chart up a little bit. Right, so if we place this, I'm going to actually do 5 contracts on this one as well, and we'll walk through placing the limit orders. So you know what, let me drop it down to 1 contract first so we can just talk to the math. In this case, we're a little farther away from the ceiling. If I'm a seller, the ceiling is always my maximum risk. Maximum risk is always what it costs to get into the trade as well. So in this case, if I trade 1 contract, I'd have $134 risk to $366 potential profit. On a sell position, the floor is always your maximum profit objective. So let's go ahead and we'll sell 5 contracts. All right. So now, one of the things we've done with this, and where I say this is a volatility trade in a way. Somebody asked yesterday about hedging, which this isn't a true hedge. If I would have executed them closer together, and I'm going to also tell you what to watch out for in this. Now, the reason this was so big in March, and something to understand about all contracts is like, what is volatility doing in the market? How much is it moving? In March, we were getting such intraday volatility that any given move, depending on the contract, let's say it was the US 500 here, you'd see a move of literally like 100 points, right? Before it blinked, right? It was moving 100 points. And so what some people were doing was basically saying, okay, I'm going to get into this trade. I'm going to do my long position here because, and let me draw a couple more lines. I'm going to do a couple more horizontal lines. So we got into our long position at 35.28. We just mark this here. So this was our long position roughly that we got into. I'm going to make this yellow for our long. Actually, how about green for our long? I'm going to duplicate this line. And our other one we got into short at right about here. Now, in a slow market, this isn't a trade, right? Well, first of all, I'm not recommending any trade. I'm just giving you something to think about here. So right now, if this moves up, right? If this market moves up, let's say, and starts moving up, if the market moves up like this, right? Between this range and the yellow and the green line, we'll say, the risk on our short trade, after that, they're going to move in a 1-for-1 ratio, right? The short trade then would get knocked out here. The long trade would continue. Now, the reason you don't necessarily want to do this in a slow market, and you even have to be cautious in a very volatile market, you want to understand what is a pretty standard move for any given market, right? Because your risk here is that the market moves up, gets knocked out, and then all of a sudden starts dropping down, right? The reason volatility, this is more of a volatility trade, is you're looking for the market to come up, and by the way, on this, you'd probably also remove this line, right? If you're looking for a volatility trade, you're looking for a big move at one given point because really you have an offsetting position. Your big risk here is the market moves up, knocks this out, and then just starts to plummet, right? Because then then you could take losses on both sides of the trade. Something to think about. I'm not going to go too deep into this, only because right now we're in kind of, well, volatility has really slowed down. But if you look right now, we're actually up a bit on both trades, which is kind of interesting because there's only a limit. There's literally a very tight limit of space that we can be up on both trades, because within this range is really the only place we can be up on both trades. But right now we could, but let's say we thought, oh, wait a minute, I had my short position on, or I put my long position on, and then I think of my short position. As you notice right now, we're just swapping P&L. If let's just watch the profit and loss for a second. We're just swapping tick for tick at this point. So I'm just gonna, you know what? And let's walk through an example here. Let's say I just wanted to get out of this position. I want to get out of one of my positions. So yeah, actually, here's a great question from Adam. So you can't do a long and short in the same bracket. It'll cancel out. So it'll just net out and you'll be out of your position. But by using two different brackets, they're exclusive of each other. What's happening in one bracket isn't happening in the other. Now it's the same market. So you can actually take, let's say you want to take a long position in one bracket and a short position in the other one. That you can do. But again, you want to be aware of what that's doing. What the market's doing. If it hits the one and then it turns, where's my risk sit? It's still, a trading decision. But I know, and Adam, it may have been you that asked that yesterday. So let's just say though, I wanted to get out of one of these trades really fast. Again, very important. I'm just going to go here. I'm going to click from my position window. We're going to take the 35.20 to 35.70 out. It's going to open a position. It's going to open a ticket for our full position in the opposite direction. If I want to get out fast, I can just choose a market order, click place order, right? So now I'm out of that trade. Now I've got my short position of 5 contracts on. So let's go ahead and walk through setting a limit order again on these, because I know somebody answered about good till canceled. All right, so now our bracket that we're trading is this one. We're in a short position on this bracket, and I'm just going to get rid of a couple of these lines here. Delete. All right, so we're down right now about $235 on this 5 lot. Again, if we wanted to close out that quick, what do? We click on the open position. It'll open it the opposite direction. We're going to click market, and we're going to click place order to get out. But let's say we still have a little bit of faith in this trade. By the way, does anybody notice a mistake I made? What did I do when I closed out my first position? I forgot to go in and make sure that these limit orders weren't canceled out. I actually did that on purpose. What we want to do if we don't have a position, because if this market starts to fly up, yep, exactly. Good catch, Jabari. If the market starts to fly up, all of a sudden I've got these sell positions on that I didn't even know or didn't even want. So I'm going to go in here. I'm going to click on these. I'm just going to delete this order. Click on these and delete this order. You always want to double check that, right? So I'm going to go back to my positions, and I'm going to walk through limit orders, and I'm going to start taking some of these questions coming in. So, all right. So setting limit orders, we're in a short position. So if I click on this, we've got a short 5. We click on US 500. I'm going to set a limit order. So what I want to do in this case, I want to set a limit, good till canceled, right? That's going to mean it's just resting there. So it'll be there until it either gets hit or until this contract expires, right? So I'm going to set my first limit for 2. And one thing I'm going to do here, I'm going to actually go back first and say, you know what? Hey, maybe this is my target zone right in here. Does everybody see that? We kind of have, oops. Let's do a horizontal line. See where we kind of had like this range, like right through here, kind of got some chop going through there. We might even be at a level where we see some support. So maybe our short wasn't a great short. Maybe we should have stayed in the long. Letitia is asking why 2 contracts on the limit. This is just an example. Sometimes you might say, hey, I want to take off all 5. Sometimes you might want to say, hey, I have 5 on. If it's really running in my favor, maybe I put on a couple more and try to maximize my profit. What I'm really just showing is how you can scale out and then manage the position, but it's also how you can lock in some profit. So you're not waiting for those maximum profit to happen. You're locking in some profit along the way so that if the market does turn, right? If the market does turn, you can just go ahead and close out the remainder and hopefully still have some profit. or even if it goes down to the floor and knocks you out, you've at least had a break-even trade is kind of the goal. All right, so let's go back to our, I'll set this here. I'm just going to use this yellow line as a first profit target. So again, I clicked on this. It's going to open the ticket in the opposite direction. So I sold the initial one. Now this is open as a buy. And you know what? I'll set 3 contracts. Say 3 contracts. If it moves down basically 28 points, click place an order. And so now if it comes down here and hits this yellow line, it should fill my 3 contracts. If it keeps going, I could keep trying to maximize profit. If the market turns, I can just close my position. Seemed like there was one more point I was going to make before I get to these contracts. It'll come back to me. I think we covered the most important aspect. So this is basically, you know, it is really just like trading in the underlying market, only you have a fixed range which it trades in. Oh, real quick. So let's say it's a Friday, this is what I want to cover. So 2 ways this can expire. It can expire by touching one of the ranges. In case it does that, a new contract will be created. But let's say we're getting towards the end of the week, right? These expire at the end of the week, right? You can close out anytime. I mean, you can trade these. If you've got a fast moving market, you can scalp these on an intraday basis. So let's say the market kind of moved or just stayed right here at 35.29. So we're down $30. Wherever the market is at expiration time, if it's still within the range, right, which it will be, because if it wasn't within the range, it would get knocked out. So at the end of the week, typically a Friday, but if there's a holiday, it may be earlier, right? If Friday's a holiday, it may expire on Thursday. So the last trading day of the week, it's going to settle wherever that market is. So your profit or loss then will be determined by where the market is in relation. So for example, if you sold and the market is above where you sold at expiration, your loss will be the difference between where you sold and where it settles to. If the market is below where you sold, right, your profit will be determined by the level you sold, just like any market, where you sold to where it expired. And so these are considered a variable payout because it's not, unlike a binary option, which is all or nothing at expiration, these will settle to where the indicative underlying market is at that time. So let me go through and take a couple of questions here because it looks like I've got a few of them built up in the queue. Again, a great group today. Yes, there's actually a question about the trading competition. So yes, that is open to everyone. With regard to the grand prizes, those are limited to U.S. residents, excluding Rhode Island, aged 18 years or older, with the contingent that you have to place a minimum of 25 trades. And the reason it's restricted to who can win the grand prize is really due to legal structure. Even on a state by state, we had to verify all of the regulations, make sure we're in compliance with all of those, which is why Rhode Island is excluded. So apologies if anyone from Rhode Island is on the call. Not my choice, but it was really a matter of the state by state regulation that it had to be excluded. And then when we get into country by country regulation, it unfortunately gets to be a bit of a gray area. So, but anybody's open to do. Because it should be a lot of fun and a great way to really learn the platform. And I encourage everybody to trade it seriously, not to just go in and try to double up and get lucky. I mean, you could have a pigeon fly in and throw some seeds on your keyboard, and maybe they could execute a trade if that's what you want to do. But you wouldn't do that with real money. So trade it and then trade it seriously. Let's see. I think here's a question. So I'm going to try to focus more, but I'll answer this one. I'm really going to try to focus more on knockouts, just as not to confuse. But excuse me. The question is, as far as binary options and the difference between regular options. So there are some very similar things to regular options, although Binaries, because they're all or nothing. So for example, if you trade a regular option, it's very linear with the underlying market. There are things like option premium, and we'll talk more about that tomorrow. Um, there's option premium. Option premium is expressed a bit differently in a binary option. The biggest difference is how they settle, right? With a binary option, it doesn't matter if you're right by 1 tick or 100 ticks, or wrong by 1 tick or 100 ticks. And when you're buying or selling a binary, just like all Nadex contracts, you have defined risk and defined reward. When you're trading regular options, if you're, let's say you're buying a call, right? If you're correct by 1 tick, well, you make 1 tick. Then again, if you're right by 100 ticks, you make 100 ticks. You pay some premium for that. I'm going to talk actually more about uh, um, premium tomorrow a little bit, which I'll break it down. I'll have time to break it down a little bit so it's not too confusing. Because I really think call spreads are a great contract and probably underutilized by people that are trading particularly futures and currencies. Let's see. So the set knockout does not have to be taken. Correct. Yeah, you don't have to wait for a knockout, right? You could place your limit orders, or you can just go ahead and close out your position. And I really want to stress that point because, as I mentioned with binaries, one of the biggest mistakes I see people do is not take profit in their trade. I mean, I've seen that in every market, to be quite frank. Um, and so that I don't want people to think, hey, these are weekly contracts, so I have to trade them as a weekly. Now, one of the nice things, if you are, let's say you're trading futures, you're probably familiar with this concept of overnight margin. Most brokers will offer you day trade margin, but then if your position rolls into the evening, your margin requirement will go up to maybe, like, let's say it's something like the ES and you had $500 intraday and all of a sudden it goes to 2,000 overnight. When you're trading a knockout, you can hold it, until it gets knocked out or as long as possible. Your collateral requirement never changes for that. So yeah, you don't, again, that's a great question, Jabari. Definitely, you don't have to wait for a knockout, all right? You have to make trading decisions. And those are very important on all aspects. I think these are great contracts. It was a little over 2 years ago when the CEO of the exchange and a couple other people came to me and said, "Hey Dan, we want you to create a contract that has this kind of, it's got to be per our regulation. It has to be defined risk, defined reward, defined risk for both sides of the trade. But we want something that moves in linearity, meaning it moves just like the underlying market." And I'm pretty happy to say that's what this is. I still think we can make some improvements to them, and then yeah, we can always offer some additional markets, and we continue. We actually just added, I believe it was about 2 months ago, we added 2 more commodities as well as another 6 currency pairs. So we're always looking to add and improve. By the way, real quick on that, on this feedback button right here, since we are always looking to add to improve, please don't be shy about giving feedback. If you see something we can improve on, maybe how it's displayed, and we'll always do our best for that. So a question on the trading competition. Yeah. So an entry is counted as one trade and an exit is counted as a second trade. An entry and then an expiration. So if it goes to expiration or if like your contract gets knocked out, that's only one trade. So basically think of as a trade as any time an order is filled. So you get into a trade, you use a limit order to get out of a trade. That's 2 trades. Yeah, so this is a great question, Adam. Yeah, so there can be partial fills, and I'll explain that, everybody. So I'm going to just go in here. I'm going to, let me switch markets real quick. I'm going to go back to my markets here. Knockouts. I'm going to do the Tech 100. Let's see what that's moving like today. All right. So I've got, let's say this contract here. We're going to buy this. When you're looking at a limit order, if you see this, it says show market depth. Unfortunately, not yet. No hotkeys. I'm I have used those in the past, and I agree with you. We actually just launched this platform. It was in beta for quite some time. So that's something actually I would encourage you to put in the feedback on the platform. Oh wow, did everybody just see that? We had a contract. Uh, did we have a contract knockout? Oh no, I just clicked off the screen. I thought, oh hey, we had a contract knockout. That would be cool. Um, so anyway, back to market depth. So if you're doing a limit order, right, and if you show market depth, um, oh I'm sorry, this is in demo. If you were in the live account, you'd actually see a market depth here on the knockouts. Right now though, there's 100 contracts. So I'm just going to see, and being in demo, they might fill all 100. Actually, I'm not going to be able to. I forgot we did an internal trading contest, so I had to have my account set back to $10,000 as well. So I can't do 100 lot right now. But if I was to do, let's say 125, for example, and there was 100 available, provided nobody got to it first, on that limit, provided the market was still there, I'd get filled on 100 and there'd be 25 remaining. So if the market's refreshed, which you see actually in the live account, with the other markets where we have multiple market makers and you see a depth of book. Let me hop over here into binaries and I'll show you just what that looks like real quick. So you can see a little bit of depth here. Let me hop into a more popular pair here, US Tech 100 daily. So do you see how you see this depth of market, right? That's more like what you'd see in the live environment. As far as the winners of the trading competition, it's based on maximum profit or the most profit and loss after fees. After fees are already deducted, or the fees are already deducted even from the demo account because we want to make it as close to the real experience as possible, even when we're not doing a competition. So fees and everything come out of the demo account just as they would. So it's profit and loss. I'm going to be sending out a daily leaderboard of the top 10 traders. And I think it ought to be a lot of fun. One of the things I always encourage, and I've seen, we did one internally for Nadex and its sister companies, IG, which is a Forex broker, and DailyFX, which if you haven't checked out their website, I encourage you to do that. It's dailyfx.com. They do a lot of great analysis. They've also, while it's called DailyFX, and they have a lot of FX analysis, they also do it on commodities and things like stock indices. So I definitely, it's free to check out. They have a great economic calendar. So you know, any week, anytime you're trading, um, you should be aware. So I've never been a fundamental trader. I've always been technical by nature. That said, you know, if it's 7 o'clock on the first Friday of a given month and I'm just about to get into a trade, I might want to know that the giant non-farm payroll report is coming out in 30 minutes. Oh, great. Jabari uses DailyFX. Yeah, great analysts over there. They really do a wonderful job. I actually have a call every morning with them where we discuss what's going on in the markets, or actually, excuse me, I should say, they discuss what's going on in the markets and I listen. And just some great analysis. They have great content, a great economic calendar, and yeah. So the three companies here in the United States are Nadex, which is CFTC regulated exchange. There's what's called an RFED, which is basically a Forex dealer offering currency trading, spot currency trading, who's registered with the NFA. And then there's DailyFX, and we're all wholly owned by IG Group out of the UK, which is a massive FTSE traded company, really well known globally. So I've been actually with the parent company since 2008. So I've been around here well. Oh no, when you're doing the demo competition, those will be demo funds. So after the close, so if you are registered for the competition and you want to get into that account and trade and trade and trade, do so now. Start like working your way through the platform, the contracts. All the funds are going to be reset to $10,000 after we close on Friday, right? So there's no more trading. So everybody starts out at an even playing field. So yeah, The demo competition is regardless if you have a live account, if you don't, there's no bearing on any of that. I mean, if you do, great. I know I mentioned yesterday, a lot of people will open up demo accounts so that they can get the experience. And I actually encourage, demo accounts will never teach you how to trade. I don't care what market it's in. It could be futures, it could be stocks. Demo accounts just never will. The psychologically is not the same. The psychology is not the same. The emotions aren't the same. But what they're there to do is actually teach you the mechanics of a platform, teach you where the tools are. I'm not even a big fan. I know a lot of people will work on strategies. I don't even think demo accounts are great for strategies. One, typically, if you're using a futures demo account, it's delayed. There's price differences between live. If you're looking to test strategies, I actually encourage somebody to look at the live market, not necessarily execute a trade, but say, okay, I'm going to execute a trade here. If this is my fill level, right, it's still not the same, but it'll give you an idea because there's still not the emotion. So if you're looking at strategies, I definitely encourage looking at the live market. So what a lot of people will do, though, is they'll open up a demo account. At the same time, they'll open up their live account just so they have it good to go. Maybe they fund it, maybe they don't. A lot of times they'll fund it, and it might just sit there for a week or 2 or 3 or 4 until they feel comfortable as they're working the demo. And then they'll see, oh, wait, I see this opportunity in the demo account. Then they have their other account ready to go. It's sitting there. But again, there's no pressure to ever trade your live account. I'm going to actually say something to everybody here because I think it's a very important point for those of you trading live. Cash is a position. Keep that in mind. Cash is a position. And what I mean by this is, a lot of times we get into the market, and even experienced traders do this, believe me, and we're looking for an opportunity. We're trying to force opportunities. And we never want to do that. Being patient doesn't mean that we're sitting there doing nothing. Being patient means that we're being disciplined and we're continuing to analyze the market. We're continuing to look for those opportunities. We're continuing to hone our skills as traders. But a lot of times people get into the markets and they have money in there and they just go crazy. They think, I'm a trader, I have to trade, I have to be trading. Why can't I find an opportunity? Well, I'm going to take this. And it turns into a whole big mess. So don't do that. Always keep in mind, cash is a position. Let's see. Yes, you can use your existing demo trading account. So as long as you've been registered, I think, oh, for some reason it was scrolling down but not giving me all the questions. Okay, I think I've hit all the questions. I think I got them mostly out of my queue. I definitely recommend you to join. As you can tell, I'm a bit. I think all of our contracts are great. I think all of our contracts, and one of the things I like about the Nadex offering is that, like so often, if I'm just pigeonholed into one type of contract, let's say I'm trading futures, right? And maybe the markets are super volatile, right? So volatile, like in March, that I can't get in without worrying about getting crushed and most likely getting crushed, which is no fun. Or there's situations where they're just moving so slow, there's no volatility. It's like watching paint dry. There's no opportunities I can get in, but all I'm doing is basically paying a bid offer spread, and it's not working. So maybe I can trade that market 75% of the time, right? When it's more normal volatility and I can get in and execute my strategy. What I really like about the Nadex offering between the contract mix, and we're going to talk about call spreads tomorrow. I think in the super volatile markets like we saw last March, I think at those times, the knockouts were a great contract to trade because you could trade them without worrying about slippage. If it went against you, it's perfect when there's great upside, but it can only go so far against you, and you're 50-50 and it makes a big move. That's why knockouts were great when there's super high volatility. Binary options and call spreads are a little bit tougher to trade in super high volatility. In normal volatility, all the contracts really work very well. And probably I would say in average volatility, I really like, and I really think the call spreads are a great contract. In super low volatility where the markets are barely moving, binary options are absolutely great for those because like we looked at yesterday, they're going to go to 0-100. It doesn't matter if the market moves. and you can do them on a very short-term basis. So you actually have a strategy for that, where in any other market, you're not going to find opportunity. You can find it with the binary option. Also, binaries are great for situations around like big fundamental announcements. Maybe there's a Fed decision, maybe there's a non-farm payroll where you can take a direction neutral trade, and if the market moves up or down, right? That was the binary strangle strategy I talked about yesterday. You might be able to profit on that. You're looking for low risk, high reward, and that's really the thing. If you're looking at slower markets, you might be looking for a trade that you have to put up more capital to make a smaller amount, which is fine. Whereas in volatile trades, you put up a small amount and get the higher profit potential, and that's one thing I really like about the Nadex offering. And I might be biased. Yeah, oh, that's a great question. Yeah, so the winning prize. So there's three prizes. There's 5,000 for first, 2,500 for second, 1,000 for third. Those funds will be deposited into the live account. If you do win, you just have to open up a live account, which is very easy to do, because we do have to verify that you meet all the criteria, the eligibility criteria, right? As far as the United States, the state you're from, can't be Rhode Island, and that you're 18 years or older. So if you do have a live account, we'll put those funds in there. Now, one thing I want to stress is those funds are yours. So this isn't a scheme where, oh yeah, you got to trade it away. No, there is a holding period per regulation. They'll be available within a couple days to trade on. But if you decide not to trade them, let's say you're the $5,000 winner. Maybe you say, I want to trade $2,500 and take 2,500 out. You can it's the 30-day holding period. After that, you can take out 2,500. I mean, it's flexible. It's for you to do what you want, but it will go into your live account. Yeah, absolutely. If you've got these funds in your live account, right? Why do we trade, right? Yeah, sometimes we take losses. Actually, sometimes quite often we take losses. Sometimes we take profits. It's about managing that risk and trying to have a positive outcome on each trade. And so, yeah, take those funds. I would love if we're sitting here 3 months from now, because we're going to be looking, if you didn't get registered for this contest, we're going to be doing more of these as we get into the new year. I'm trying to make this a monthly thing where we do this, because I think it's a great experience for everyone. And we're really, this is our first one in a long time. We've learned a lot of lessons, but we really want to wrap a lot of education around this, because it's great to win a one-time prize in a demo trading competition, but isn't it so much better to really learn how to trade, to really do it, to become consistent in your trading, where you can do it for years and years and years. And that's what I hope to get and to give, actually, out of all of these competitions. You know what I love? We had a Predict the Dow contest the other day. I've spoken with the winner. He was super excited for that, and talking through that, and we're talking about the markets and trading, and you know what? He wants to use that money to really, because the best education you can get in trading is the live market. So, and if you're just starting out, right, take your time. Don't get into anything that you don't understand. The demo is there to help you understand. It's not there to teach you to trade. It's there to help you understand how the contracts work, how the platform works. But when you get into live trading, don't start out big. If you're a $5,000 winner, and that's why I was happy talking to him. This guy wasn't, he'd been trading for a while and actually understood it, and I was happy. And so it kind of gave him a springboard. But really great guy, great conversation. But like with these trading competitions, it's great to give away that 5,000, but I want the whole experience to be much more valuable than the grand prize. And I want that for everybody. I'll tell you 100%. I'm so encouraged and so happy when I see so many people joining these webinars like this and listen to me ramble on for an hour and overrun by 30 minutes every day. This is fun, because I will tell you, I have never seen anybody be long-term successful that didn't take it seriously, that didn't get the education, that wasn't sincere about learning, and most importantly, putting in the work. You got to put in the work. One of my mentors used to say, we could give people the Wall Street Journal 3 days in advance, and 90% of the people would still lose money. And that's because they wouldn't understand where the market was going in between, right? You think, hey, it'd be easy if I had the Wall Street Journal 3 days in advance. Well, not necessarily. It's about putting in the work. It's about managing risk. I'm passionate about trading, but I'm passionate about really, and one of the things I love about Nadex is the education, which, by the way, I'm going to hop over because I almost forgot to show you this. For additional learning, because I've been rambling on now, go check out our webinars. So right here, it'll default to upcoming. Here's the one that we're doing right now, the knockouts. Call spreads is tomorrow. But if you go to the archive, so here's the one we did on Tuesday. You want to see the one on Tuesday? Click watch now. Later today, the one I did yesterday should be up here. Tomorrow morning, this one, you should see that in our archive. So if you want to go back and review it, and they'll all be up, by the weekend. So you'll be able to review all of those. Oh, this is an awesome question. What is your most recommended book to really help traders succeed? I'll tell you. And I had the pleasure of meeting this guy and got to know him pretty well over the years. And I have a lot of really, really good books. I have a lot of like his old trading books, but I think one of the most valuable books, and the one when I'm asked this question that I always recommend, is Trading in the Zone. Mark Douglas, awesome guy, passed way too young. Oftentimes when people get into trading, they're always looking for a strategy. I remember when I started out, and I was like, gosh, if I just knew like what time frame the pros were using, what indicators they were using, I could do this. And that is not true at all. I don't care. Strategy is the least. Yeah, exactly. He also has one called Disciplined Trader. Basically, anything you can find on Mark Douglas that's from him is great. I know we're running very long here, but one other example of this that I like, because if you want to understand how important risk management is to trading, oh, thank you, Adam. I'll pass that along to the people that you know what, we are actually looking to add more of them. I'm going to pass that along though to the people who run those and contribute. He was talking about the blogs, so if you're on Nadex, underneath learning, click on blog, and I'm going to pass along those comments. So anyway, real quick, an example, and this was, I believe, 2006. There used to be a magazine called Currency Trader. I read that cover to cover every month when it came out. It had a lot of great information, strategies, everything, but they did a study, and it was a month-long study. And basically what they did was they took two experienced traders that had been trading over 5 years, had been consistently profitable over that time. They took two experienced traders, and then they took two newer traders. They've been trading about 6 months with kind of with little consistency, and they basically paired them up. They took one, we'll call them pro and one newbie. So they took one pro and one newbie, and they paired them up. And they gave them one asset class to trade. They could trade the Euro USD for 30 days. Team one could only be long. Team two could only be short that entire month, right? Now, one would say, well, geez, that should be easy if you've got a trending market. One side's clearly going to make more than the other. I mean, how can the other ones? What they found at the end of that study was that the two experienced traders both made money, even though they had to trade in opposite directions over the same month on the same market. They had to trade in opposite directions. Both experienced traders made money. Both new traders lost money. And they defined it. They did a really good statistical definition. It was only about risk management. It had nothing to do with strategy. The experienced traders, when they were wrong, they got out. They didn't take their maximum loss. They had the confidence and the wherewithal to go, you know what? I'm not going to get angry. I get stopped out. That's how it is. And I think that's a great lesson for everybody. And with that, I know we're running really long. Again, if there's questions I missed, I do try to review them or at least catch them up the next day. Tomorrow is the last day for my series this week. We've got some more great education next week. By the way, it's going to be something pretty exciting next week. I know a lot of you have caught Brian Caprice on a lot of the webinars. If not, you can catch him. Great guy, knows the markets inside and out. The teacher, real quick, on closing the contract, you just go to your open positions window right here, click on that. It'll open an order ticket on the opposite side, click place order, and that closes out your position. Anyway, so if you go to the upcoming or even the archive, you'll see a lot of stuff in there from Brian Caprice. He does a lot with the exchange. He has a great trading education firm. But they're going to be doing 15-minute segments at the beginning of each week next week with Todd Rich, who's Nadex head of education, interview style. And they're going to be talking about what they're looking at in the markets every morning. And these are going to be an ongoing, it's not just for the competition, but it's going to be an ongoing everyday thing. Because we received a lot of feedback. People are looking for ideas, particularly newer traders. And so this is something we're very excited about. You know what? I'll double check that, Adam, and get back. I should know what time those are going to be. Let me just see if I think they're going to be at 8 a.m. Central, but let me verify that. And I promise to have an answer tomorrow. I would answer it via email later, but I want to give everybody an incentive to come back tomorrow to find out that information because I love having this group on here. Some new people here today. I hope you enjoyed it. Well, actually, I hope you all enjoyed it. I've seen a lot of the same names over the last 3 days. I'm really encouraged by that. Really means a lot to me. And my end goal is to provide benefits. So if there are things you want to see as far as education at the exchange, I work directly with Todd, who's our head of education. We do our best to provide a broad level for both people just getting into the markets, as well as, we've got people at Nadex that have been trading other markets for 20 years. You know what? They actually give us a lot of great insight also. We get great insight from every level of trader. And that's why I say never hesitate. I loved being a trading coach because I learned, and I'm serious when I say this, I learned as much from new people coming into the market and asking questions that they always invariably started out with, I know this is a stupid question, but, and what they would do would give me some different way to think about a market, because as we get locked in and we do things over and over and over again, which consistency is great. But we kind of get locked in and we don't always think out of our zone. So it's always good to have that. And with that, I've got to hop. So again, I'll try to answer questions. This should be available for viewing tomorrow. Again, I hope to see everybody. Tomorrow. Have a great day and wish you the best.